Hello, everybody. And I can't thank you enough for taking time out of your day, which this webinar I think will be very timely. It's our second quarter 2023 market and economic update, and I think you're going to find it very informative. I thought last month our Wealth Women in Wealth webinar was really well attended, and a lot of people got out of it. If you missed it, please go to our website. You can view it. There's a lot of good information that Nicole, Harmony, and Samantha provided. But today we're going to talk about the market and the economic update. And with everything that's going on, it's really, as I said, timely. So today our presenters are going to be Ryan Bouchey, who acts as our Chief Investment Officer, and also Paolo LaPietra, our Wealth Advisor and Portfolio Strategist. Ryan and Paolo both are really taking charge and really doing so much with the investments. And I think today's presentation will be dynamic. You'll enjoy it. And once again, thank you for taking time out. With that being said, without any further ado, I'd like to hand it off to Ryan Bouchey.
All right, thank you. Let's look at today's topics. We're going to just give a brief overview of what we've seen so far in 2023, talk a little bit about the markets as a whole, what's driving especially the strength that we've seen, and how we've positioned the portfolio so far year to date. From there, I'll have Paolo kick it into what recession, right? We've heard the headlines for so long to start this year of the impending recession. We'll look a little bit at the economic data and what that's pointing to us. From there, we'll talk about yesterday's inflation report, the Fed and the fixed income markets, how we're viewing that, and how that relates to your portfolios. And finally, we'll just take a look at kind of overall big picture market outlook and expectations from here. So let's kick it off, right? We're officially in a bull market since about mid-June off of the October lows for the S&P 500. We're in, believe it or not, a true bull market. And we were going back and forth on what to title this slide, and finally landed on the pessimistic bull market. And you have two folks here saying he's still there, isn't he, right? And we still have this bull market with us. And the reason why we chose the pessimistic bull market, it goes back, if you've heard the famous quote from John Templeton, and it says, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die in euphoria. And it feels like this bull market has certainly been born on pessimism. I don't think there's been a lot of optimism to start the year, whether it's headlines, investor sentiment, you name it. It's been mostly, probably a negative view on this bull market for a long time, what many people thought was maybe a bear market rally. And so we'll talk a little bit about these themes later on in the presentation. But let's take a look at first half market recap and just kind of some of the major indices we look at. The NASDAQ, that primarily growth technology type companies, just an amazing bounce back from the bad year it had in 2022. So far year to date, up almost 32%. The S&P's been slow and steady, really, really good first half of the year, up almost 16%. The Dow Jones, and really a flip of what we saw last year, right? Dow Jones, even though it was down a little bit, had much better performance versus, say, the NASDAQ. But so far this year, Dow Jones has really been lagging the other indices. We don't really take that into account, as you know, from listening to us on these webinars or the radio, but that's only up around 4%. And, the Bloomberg US aggregate, that's the US benchmark for the overall bond market, I would say, up a little bit over 2%. And it might not be much, but it's much better than what we saw last year. So a lot of strength all across the market. And we'll look at what we've been doing in our portfolios. And, from our last quarterly webinar, quarterly update, really not much has changed, right? We continue to be overweight US equities. We have not, delved into too much international equities. And that, there was a brief moment in time around the turn of the new year where international equities were outperforming, but that's come back into check and US equities continue to outperform. Technology, right? we hold a pretty large overweight to technology. We QQQ, one of our big core positions, the NASDAQ 100, and something we'll talk about again later in this presentation. But that served really well so far. We've added dividend growers to the portfolio. We've added quality, profitability type of companies. We think those are going to fare very well in this current environment. And throughout the end of last year into the beginning of this year, we've added to our fixed income sleeve some treasuries. We feel there's good yield there, essentially a risk-free investment for the most part, notwithstanding the debt ceiling crisis we almost saw ourselves in last month, but we feel very comfortable where yields are right there. As I said, continue underweighting in international equities. High yield debt, we really haven't gone to so far. We really like to be conservative in that area of the portfolio. Financials, a lot of uncertainty, what we saw earlier in the year. High rates sometimes can be good, but we're seeing a big shift into non-savings accounts. That could be a headwind for financials. In real estate, right? We still haven't really had a full bounce back from COVID. Still hesitant on the overall real estate market across the country. So, we continue to be overweight there. From there, I'm going to turn it over to Paolo to lead us into the next stage of our presentation. So take it away, Paolo.
Thanks, Ryan. So what recession, right? We go back to Q4 of last year. Everybody and their brother was convicted on the fact that we're going into a recession at some point in 2023, right? It wasn't a question of if we were going into recession, but when. Well, the economy and the markets have been telling a very different story, and where I want to start this story with is the U.S. consumer. And one of the biggest, if not the biggest concern at the end of 2022, looking forward to this year, was that the consumer wouldn't be able to keep pace with inflation and higher interest rates, and that would eventually tap out or even over leverage, the consumer with debt. And this is important, right? The U.S. consumer makes up 70% of the U.S. gross domestic product. So without a healthy consumer, we don't have a healthy economy. But as we look here, first at the left of this chart, we could see the U.S. consumer balance sheet is in a very healthy position with assets towering over liabilities. Now, something to note here is one of the largest assets and also liability is homes and mortgages. And that's, something I'll address in the next few slides. But also taking a look at the right of the chart, we could see household debt as a percentage in the top right, still at historic lows. Now, we've seen an uptick from the pandemic lows, but nonetheless, again, extremely healthy. And if we look at the bottom right of the chart, here we're looking at delinquencies on auto loans, credit cards, and even student loan debt. Again, all three are in a healthy spot compared to historical averages, but we've seen some material effect to tighter monetary policy as we've seen an uptick in credit card and auto loan delinquencies. So why is the consumer in a good spot? Well, for one thing, the U.S. still has a very strong job market, and there's a correlation here. A fully employed America is a fully funded consumer that will go out into the economy and spend. And that's certainly been the continued case here in the U.S. with unemployment rates sitting near historical lows at 3.6%. And taking a look at the left of this chart, we could see job openings still sitting at historic highs, but coming down from its peak in March of 2022, but still showing signs that there's a lot of job openings out in the economy that still need to be filled. And this can be problematic for the Fed. With so many job openings and not enough workers to fill them, the simple imbalance between supply and demand causes upward pressure on wage inflation. And Jay Powell's come out and said that people will need to lose their job in the Fed's fight against inflation. And what he means by this is by getting the labor market in a more healthy balance where job openings match the amount of available workers. And a key metric to look for when trying to find if we're making progress on a more healthy balance in the labor market is labor force participation, which I'll discuss in the next slide. So we have a few charts here on this slide, but where I want to focus is on the top right of this chart that shows labor force participation. And here we have two lines. The light blue depicts the age group between 25 to 54 years old, better known as the prime age group in the labor market. And the dark blue line shows the age group of 55 plus. And this chart does a great job on helping us understand why there's so many job openings in the US and why unemployment is near historical lows. If we look at the year 2020, we see a massive drop off in labor force participation for both the prime age group and 55 plus. And this isn't due to layoffs. So, we need to remember here, labor force participation tracks all able-bodied workers that are either employed or actively seeking employment. So people that were unemployed due to, a layoff during COVID or any other situation would still be counted in these percentages. And what's important on this graph is the divergence between what we see in prime age group and 55 plus after 2020. We could see that many people in 55 plus decided to retire early when COVID hit. And we call this the Great Resignation. My colleague Vinny Tessa wrote a great piece on this. And while the prime age group now has a larger labor force participation number than before the pandemic, and it's still gradually increasing, there's still a slack due to the that drop off in the 55 plus. And this really helps us understand why there's been such a large gap between job openings and not enough workers. The healthy sign here, though, is the prime age group continues to go back to work, which will continue to add to the supply of workers, which will, help in that imbalance for job openings and, ultimately bring, wage inflation into more sustainable level. So if we remember from the first slide on the consumer, homes make up a large part of the average consumer's assets and also liabilities. So the overall health of the housing market is very important for the economy. And there was a lot of speculation over the last 12 months that the pace of the Fed raising rates could, potentially lead into some sort of housing market crash as demand would diminish with higher mortgage rates. We haven't bought into that story. We still haven't bought into that story. And that we remain convicted on the fact that the only issue in the housing market is a lack of supply. And if we look at the graph on the top right, we could see housing inventories for new and existing single family homes for sale. We could see that inventory still sits at a 40-year low. The lack of supply has kept pricing in the housing market very stable. And, even in the face of 6-7% 30-year mortgages, and that's important. Now, if we look at, the top right still, we could see that single family homes start to gradually, new starts, meaning new builds, are making pace more towards that 60-year average. And that's healthy. While price stability in the housing market is very important, price surging also isn't great. So trending back towards a more normalized supply for houses, will definitely be a positive addition to the overall housing market. The other element in the housing market is the renters. So rent has been one of the stickiest components to inflation over the last 2 years. And if we look at the bottom left chart, here we're looking at rental vacancies. And as of Q1 of this year, this number is sitting at 6.4%, we could see on that chart. And compared to that, to that 60-year average of 7.3%, we're below that. So again, the imbalance of the supply compared to the overall demand has led to the push in higher rents. But if we look closer, we could see that rental vacancies are starting to creep up more towards that historical average, and that's due to the, that increase in multifamily housing starts, as we could see in the bottom right of the chart. And having a continued supply of apartment buildings and multifamily homes have helped bring the supply and demand more in line, which has been a key factor in keeping rent inflation more in line, which is important when we cover inflation in some coming slides. So just a quick recap here. We saw the consumers remained resilient in the face of higher interest rates and tighter monetary policy. And this is important as the consumer spending makes up such a large part of our economy. The job market also remains strong. And with the prime age group, workers continuing to come back in the labor force, this shows signs of a healthy long-term job market. And finally, the housing market, continues to remain stable, even with higher interest rates. And this is important because homes make up a large part of the consumer's balance sheet. Also, rent is starting to cool, again, which is an important sign for inflation, as rent has been one of the stickiest components of inflation. So the next few slides, I'll discuss inflation, the Fed, and fixed income. So another great graphic from our folks over at Hedgeye. We got one guy that's looking at the 4th of July fireworks, and he's saying, hey, is this from the 4th of July? And the other guy saying, no, the Fed's just blowing things up. And that was a lot of the sentiment, even this year and going back in the last year, that the Fed was raising rates way too quickly and something was just going to end up blowing up. So love using this cartoon. So let's check in on our progress on inflation. And for any one of you that are watching this presentation today that have seen our prior quarterly webinars, you know that the inflation heat maps are a common theme in my presentation. The heat map allows us to see where we're seeing increases or decreasing in prices in all different sectors. And this is important to understand how we're faring in our fight against inflation. So yesterday we received a very important update on our CPI readings for June. Headline inflation came in at 3% year over year, which is down 6% from our 40-year high of 9.1% that we hit in June of 2022. Inflation has now fallen for 12 consecutive months. Katie, can we go back to the last slide, so? Thank you. So inflation has fallen for 12 consecutive months. And what we can see from this heat map, that some of the largest contributing factors for this has been energy. We look at the first half of this year, energy is all in green, meaning we've seen a fall in energy prices across the board. But where I think the most progress that has been made has been in core services, which is in the bottom of the category. And core services are extremely important category for inflation because it makes up 58% of the CPI weighting. And one of the main components of core services is shelter, meaning renters and homeowners. And we could see a cooling here. And as I discussed in the housing slide earlier, the increase in apartment supply and multifamily homes is certainly a contributing factor towards this. So the continued progress on bringing down inflation is a key factor in the decision-making that process for the Fed and where they're going to take interest rates going forward. So on the next slide, we'll take a look at where we currently stand with the Fed funds rate and where we should go from here. So the Fed, here we want to look at, Fed funds rate, and it, currently sits at between 5 and 5.25%. That's where we could see in that gray line. And the $1 million question here is, where does the Fed go from here? And we have two camps. What the Fed is telling us what they're going to do, which is highlighted in blue, and what the market expects the Fed to do, which is highlighted in green. And Jay Powell a few weeks ago said that they expected to raise the Fed funds rate 2 more additional times this year, each at a quarter basis point or 0.25%, to bring the that Fed target range from 5.5 to 5.75%. And the market isn't fully convinced on this. They think the Fed will only hike interest rates 1 more time at 0.25%, bringing up the Fed funds rate between 5.25% and 5.5%. And with that great CPI report we got yesterday showing headline inflation coming down to 3%, inching closer and closer to that Fed target of 2%, it would seem that the market has the more accurate expectations here. Where both the Fed and the market come into agreement with is both are forecasting interest rates to be cut at some point in 2024. And this is going to be an important factor for markets, especially when we're discussing bonds, which I'll do in the next couple of slides. So for the first time in a long time, we could finally start getting excited on the prospect of bond outlooks. And where I want to start this is with real yields. Now, here on the chart, we're looking at 2 different readings, nominal yields and real yields. Now, nominal yields, which is shown in the blue, represents the coupon on the bond that you hold. And for this chart, we're looking at a 10-year treasury. So if you look all the way to your right, you could see that the nominal yield or the coupon on the 10-year treasury has been steadily climbing for the last 2 years. And this has to do with the Fed raising rates. The issue is the real yield that we've been realizing. Now, real yield, which is, that gray line, represents what your actual return is from the coupon after inflation. So for instance, if you have a bond coupon of 4%, but inflation is 6%, you have a negative real return of 2% since inflation is outpacing your coupon. But as I discussed on the previous slide, we've been making tremendous progress on inflation, making the prospects of real yield less of that distant dream and more of an oncoming reality. And while comparing that to the late 70s and 80s may be a little bit of a apples to oranges scenario, we could see historically during that time when the 10-year treasury has a negative real yield, that real return has a great bull run for the consecutive years following as inflation comes down. And this is a main factor in our bullish bond outlook for the remainder of this year and heading into next year as well. So one of the other factors that has us so bullish on our bond outlook has to do with the basic bond principles. And here on this chart, we're looking at a correlation between the 5-year total return versus the starting yield to maturity on the Bloomberg US Aggregate Bond Index, which is essentially what the S&P 500 is to equities, as this is for bonds, one of the major indices that we look at for bonds. And the green dot on this chart represents a starting yield to maturity of that ag over the years, which is the x-axis, and then the 5-year total return for the ag, which is the y-axis. And what we find over the years is 89% of the ag's performance is attributed to its starting yield, which as of this month, the ag's starting yield to maturity is 4.81%. That's a very attractive outlook for the ag over the next 5 years. And when we couple this with the probability of the Fed cutting rates at some point next year, our thesis on our bond outlook only grows stronger. So just to recap this section, we've seen that the US has continued to make great strides on the fight against inflation. This was supported with yesterday's headline inflation coming in at 3%. And this is important for the Fed's outlook for interest rates. Jay Powell said they'll hike, 2 more times, but the market is only pricing in 1 additional hike. And yesterday's CPI report certainly sides with the market. And finally, we're bullish on bond outlooks as interest rates are attractive and inflation coming down will make real yields attractive going forward. And for the next part of the presentation, I will pass it back off to Ryan.
All right, great. Thank you, Paulo. So to close it out, we'll take a look at our market outlook, use some data and some research to help support that, and just some closing thoughts on where we're at in this cycle, what we see ahead, and what to be cautious of. It's a lot of positives here, but there's certainly some areas that we want to be cautious of moving forward. So back to that earlier theme that I touched upon, this Trojan bull market. Again, as you can see, I think from the illustrator here, they're probably a little bit more bearish than we are. And as they're looking at this bull market coming in, what could possibly go wrong? And that's kind of been the theme so far the first half of this year. Is this rally? Is it a bear market rally? Is it a true market rally? Now that we're technically in a bull market, it is a bull market, but is it sustainable? Is this here to last, or are the bears going to come back? Are we going to get a pullback from here? What is really the sentiment of the market? So when we look ahead, as I said, won't spend a lot of time on this chart, but bye-bye to the bear market. We did technically in about mid-June pull out of the bear market we saw in 2022, and the market recovered over 20% from the lows in October. The Nasdaq is having a great run as well, but the overall S&P, which I would say is more of the main index for the U.S. equities, as Paulo alluded to, got out of the current bear market, and it's technically considered a bull market. But there's still some skepticism there. And as we look to the next slide, I think this is an interesting one going back almost 100 years. Looking at what you would call a retracement, right? So sometimes you do in a longer bear market, you do get what they call bear market rallies, and you get a recovery in the market only to pull back down. We saw that in the global financial crisis of 07 and 09. We saw it in the tech bubble in early 2000s. And when you look back over history, there's been about 20 of these. Very rarely do you get a retracement over 50%. About a month ago, we were at a retracement level of 64%, meaning we've recovered 64% of what we had lost before in the last bear market. And even since then, the market has only gone up, and we're probably closer to about a 70% retracement. So, not saying that we have to base everything on historical measures, but we have not seen a scenario in the past where we've had going back into a bear market with this sort of recovery that we've seen thus far. So I think it would take a lot at this point to sort of get back to those lows that we saw in October and in December for the NASDAQ. One of the major kind of talking points that we've seen and we've dealt with, I talked about it in a Friday newsletter I put out a few weeks ago. It'll be part of the market quarterly update that will be sent out. But this idea that it's been a really narrow recovery. And when you look at this chart, this is through about mid-May. So far through that time, really the S&P's gains, and the S&P's gains were pretty strong at that point, almost about 10%, were primarily driven by 7 companies. You had Google, Amazon, Apple, Facebook, Microsoft, NVIDIA, and Tesla really accounting for all the gains in the S&P, whereas the rest of the companies in the S&P, without those 7 companies helping, would have been at a loss. And so that was a big talking point in terms of, well, it's not a true recovery. It really isn't sustainable. We're not seeing market participation here. It's what are we going to get moving forward? And if you go to the next slide, the next few slides are pretty technical. I'm going to do my best to just explain kind of the thesis of them and what they really mean. And so this chart goes back to the mega cap divergence, right? Those 7 companies, how much they were outperforming the rest of the market. And when you look at it kind of towards the end of April, the thesis back then was there's 2 things that could happen. You could get continued divergence where those mega caps continue to just really outperform, which would, honestly, would be a negative probably moving forward for the overall market on a longer term basis. Or you could get more market participation. And in the time, I don't know, 5-6 weeks since then, we've had dramatic market participation. Really, since about the end of May to early June, all of a sudden we've had much, much more companies participating in this market rally, which proves a real positive for us moving forward. And if we look at the next slide, not only is obviously the overall market starting to get more participation, but you got to think about what momentum means to the market. And so again, this slide is really technical as well, but it looks at the 200-day moving average for the NASDAQ 100. That would be our QQQ that we hold in the portfolios. And we always I always like to use a combination of fundamental analysis and technical analysis, because go back to the global financial crisis. Stock valuations were actually pretty good, even though we had one of the worst market sell-offs since the Great Depression. And so can't base everything. Fundamentals are a great metric of the market, but you can't base everything on it. We do like to include some technical analysis to just help make sense of what we're seeing and using a combination of the 2. But this shows the 200-day moving average in kind of a recovery from a 20% negative deviation. So more companies being below that moving average, which usually isn't great for market momentum, to now we're seeing in the NASDAQ 100 plus 20% divergence. So more companies that are above that 200 moving day average. And why this chart is really interesting is that historically, this is a really, really big positive for the market, especially the NASDAQ 100, again, that QQQ holding that we have. And so sometimes it feels like, especially with winners, how long can this go? It's really hard to kind of make that decision of, do you want to continue to hold? Should you sell some of it? Kind of getting nervous about continued, upside potential. But what this shows us, and we're kind of in this cycle right now, is that, 6 to 12 months later, it's been a real positive for this index. And so again, doesn't mean everything, but we do think it's really important that we like the momentum that we're seeing in this area of the market. And it's something that could continue forward to kind of sustain this bull market that we think we're in. So along those lines, right? So we're talking about more market participation. So again, this chart is a little bit technical, but the main point is, from a historical basis, that black line cutting through this chart is kind of the normal correlation in the largest 5 sectors of the S&P. Those 5 sectors make up, I think, 65 to 70% of the overall S&P 500. And so what it tells us is, when correlations are high, so meaning, those different areas of the market are all moving in lockstep, they're moving together, typically not a good thing for the market. You usually see that when you get major sell-offs, right, where most of the market is selling off. That's where you would typically get pretty high correlation. But when those correlations start to come down, when those sectors and areas of the market aren't always moving in lockstep, it's actually a pretty positive sign for the market. And that trend has been coming down. And so we're coming below and somewhat well below what that average has been. And again, typically that has been a pretty positive sign for bull markets. It's a good thing when we see that divergence in different areas of the stock market. You may not have everything going up at the same time, but from a long-term perspective, it could be a positive. So along those lines, right, looking at mid caps now, we do have an allocation to mid caps in the market. And so far, honestly, year to date, they have not been performing as well as those large caps, especially those mega cap growth companies have done. But when you look at their fundamentals, right, they're trading at such a discount to large caps, biggest discount of the last 30 years. We see a lot of value there. And like I said, since June, we're seeing much more market participation, especially in mid to small caps, that we feel this is an area that, yes, maybe it's an area that hasn't done as well so far year to date, but moving forward, we have, pretty strong conviction that, these are areas of the market that we want to participate in if we see this sustained rally continue. Similar theme, again, for small caps. This looks at about the last 20 years or so of mega caps, how they've beaten smaller companies kind of in real time. And as you can see in the chart, where we're at today is really the biggest divergence we've seen in these last 20 years. So yes, small caps, it hasn't been great for them so far year to date. But again, we're starting to see more participation. And the fact that they're at those high elevated levels, we don't think, again, that's going to be sustainable. So doesn't mean that we don't think those, going back to that NASDAQ QQQ side, that those large cap growth companies can't continue to do well. But we think that there's going to be other areas of the market that are going to come along for the ride as well. We've talked about, in the past, sort of our allocation to quality companies, right? Dividend grower companies. And so this chart, I really like this chart. The two charts goes back over 30 years, looking at companies that have, one, the highest yield, companies that are non-dividend payers, companies that are dividend payers, and then companies that are dividend growers. And over those 30 years, those dividend growers have the highest annualized total return. If you look at on the left side of the chart, those non-dividend payers are right in line with them. But what I think is even more important to take into account is on the right-hand side. So you have your total return on the vertical axis. So again, those dividend growers in orange are right in line with those non-dividend payers, essentially at about 12.3% annualized return. But that bottom horizontal axis, the standard deviation, so that is a measure of risk within the market. And as you can see, those non-dividend payers, further out you go, they got about a 50% higher risk standard deviation metric versus the dividend growers. Now, who are those? Who are the non-dividend payers? They are typically those, high growth, those mega cap growth companies that, they're pumping that money back into the stock. They're not really sending out dividends to their shareholders. They're really putting it back into the company because they're putting it in for total growth. And returns have been there over the course of time, especially over the last 30 years, but they are a little bit more risky. This is why we really, really like the dividend growers in those types of ETFs that we're holding now, because over time, they have been really, really strong companies, but at a lot less risk in the overall market. So there will be times where, they may not perform as well. And again, they're not performing as well so far year to date as those growth companies have been. But we do think over the long term and over a market cycle, especially from here, since we've had such a divergence in those large cap growth companies, we think those other areas of the market are going to be really, really poised to do well moving from here. And so the last slide I want to share with you, and this is a major theme that we talk about all the time, is, beware of the headlines. And I think this is such an interesting chart because you look at it. So this goes over the last 18 months or so, essentially from the start of 2022, which was the peak of the rally before. So all of 2022 was essentially a down market. And we really started to recover between October and December of last year. So it covers about 17, 18 months. But this is percent buy ratings from Wall Street analysts. And what I just find so fascinating, so again, whether it's Wall Street analysts, whether it's the headlines, you see over that bear market of 2022, the buy ratings continue to go down with the market. And listen, we're all human, right? But, when things were at its worst in December, January, that's when the lowest buy ratings were. If you followed, that trend, if you followed, the headlines of how bad the markets were, it's going to be tough to do well in a long-term basis. You really have to sort of tune out the noise and come up with a strategy and a long-term strategy at that really works well. And I think with Paulo, myself, the rest of the investment committee, as you saw from today's presentation, we're pulling data and information from a lot of different places. I like to look at, bearish sentiment and positive sentiment. You got to find it from a lot of different places. So just beware when you see, one headline or one analyst report, because there's a way you can take any piece of data and turn into the favor of the argument you're making. You really have to take a step back and look at the big picture when you're doing this. I just thought this was really interesting to see, the experts on Wall Street, and essentially, if you followed kind of that sentiment, would have been the worst thing for you. So a lot of positivity here, right? I mean, we're showing why there could be continued strength in the market. And I think that's important to point out because there's been so much negative sentiment. But there are areas that we're going to continue to watch closely that, we should proceed with caution on, right? We've had the Fed kind of at this stage where it's at now, but, for this market rally to continue, we really need to see earnings strength. We need to see earnings strength. So this quarter is going to be huge. The last half of 2023 into 2024 is going to be critical from an earnings perspective. Not only did we start seeing more market participation in June, we actually saw market sentiment shift pretty dramatically to start June, whether it was in the news and headlines that all of a sudden those negative headlines kind of started to shift. I always will take some caution when sentiment changes like that. Just not that we're full contrarians, but again, as you saw from that chart of analysts, sometimes they can get it wrong. And so sentiment, while it can be a positive for sustained rallies, you just want to be cautious on some dramatic changes like that. We're still seeing a huge yield curve inversion, right? And that's always been an indicator of recession. So just again, some of those kind of metrics that are out there, we're going to continue to watch and be aware of. And I had this continued data disruption from COVID, right? Whether we get month over month data, year over year data, some of the historical graphs that we showed, and being cautious not to base everything from a historical basis or some of this current year over year trends, because we've had so much being disrupted over these last 3 years. I do think it's going to take a few years for it to still all fully shake out. So we just want to be aware of that, and we never will base everything from just a purely historical basis as well. And I think right now more than ever, because we've just lived through a very unique time over these last 3 years. And some closing thoughts you want to leave everyone with. It does feel like the least celebrated bull market. That quote from John Templeton, bull market starting on pessimism. It really does feel like that's where, this first half of the year certainly started. And, when we look at some of the data that we're seeing, and from a lot of different places, there is that support that this could be, this bull market that we're in could be more sustainable than a bear market bounce that many predicted early on. The breadth of market participation is so encouraging. That's been a really positive sign over the last 5 or 6 weeks. Talking about not fighting positive momentum, ton of momentum in the NASDAQ 100. That's a good thing. We truly feel diversification will be important for the second half of the year. So even some areas of the market that lagged in the first half of the year, really you're not willing to give up on them right now, because we see a lot of momentum and a lot of positive moving in their direction. And as we talked about earlier, I think earnings season's over the Fed announcements right now. I think we're kind of moving into this post-Fed market, which could be a really good thing, with less emphasis on what the Fed is doing and saying, because I think the market has kind of priced that in so far, and really a more focus on what's going on in the economy and kind of this what they would call post-Fed market, which again, historically, if you look back, 09, we were in one of those, 03, early 90s. Those have all been really positive times. They'll need a catalyst, and that could be earnings. It could be, AI that we've talked about in the past. So there definitely could be catalysts to keep this going. So with that wraps up today's market update. Thank you to Paulo. Thank you for everyone who joined us today. If you have any questions, feel free to reach out. We'll be sending out a recording, putting it on our website as well. And if you think anyone that family, friends can benefit from this information, please don't ever hesitate to reach out to them and share some of this information. We love that you were able to join us, and we appreciate you participating and being part of it. So again, thank you.